Hello, my name's Paul Nieder and welcome. Today we're going to talk about the CCIV and tax, sort of an overview. And if we spread that out further, it's the CCV and tax, but it's sort of like Australia's new corporate collective investment vehicle and the taxation aspects related to it. Now, the CCIV is a new Australian corporate entity from the 1st of July that is more attractive to overseas investors and that foreign investors are more familiar with. Now, each CCIV will be an Australian registered company, limited by shares that meet the regulatory requirements of the Corporations Act. And now, while not everything's bolted down from a taxation perspective, especially with the transitional pathways from existing entities like trusts and things like that, there are many things that we can actually detail here at the moment. Now, the main reason the government pushed for the finalisation of the CCIV or CCIV regime was for the encouragement of foreign investment and to enhance the competitiveness of Australia's funds management sector. Now, they aim to be legal structures that are more recognisable to foreign investors than the typical trust-based managed investment scheme that operates in Australia. It's designed to boost overseas investment in Australia and provide economies of scale for both foreign and domestic investors, which will result in lower investment costs. The CCIV is going to be an investment vehicle that has a public company structure and it's limited by shares. Sort of operates like an umbrella fund with sub-funds underneath it holding various asset types. Now, the CCIV must have a corporate director, a legal entity, which is an Australian public company that holds the relevant Australian Financial Services Licence, an AFSL. This results in a company structure supporting single responsible entity sub-funds, each of them singularly responsible. Now, each sub-fund has assets and liabilities segregated, and for tax purposes, though, it's treated as a separate entity. A sub-fund can pass on franking credits, discounted capital gains, and foreign income tax offsets to investors. Now let's look at 6 particular topics related around this. First of all, alignment. One of the prime objectives of the tax treatment of the CCIV was to align to the existing AMIT tax regime, and AMIT stands for Attribution Managed Investment Trusts. The second one is a sub-fund is deemed to be a unit trust. Now, under each CCIV, sub-funds are segregated investment entities. Now, these sub-funds with their segregated assets and liabilities are treated like existing unit trusts. The members or investors in the CCIV or the relevant sub-fund are treated as the beneficiaries of the CCIV sub-fund trust. This makes the CCIV appear to be the trustee of the sub-fund. To summarise then, for the purposes of tax law, a trust relationship is deemed to exist between the CCIV and the related business. The assets and liabilities referable to a particular sub-fund and the members of the CCIV unless this relationship is expressly excluded. Number 3, a CCIV is not required to be an MIS or managed investment scheme. Now, while a sub-fund has to be used to aggregate investment through pooling contributions from members, the CCIV satisfies regulatory requirements and the widely held test has removed the MIS requirement. Number 4, flow-through tax treatment. From an Australian income tax perspective, CCIVs may be entitled to flow-through treatment. This means that the CCIV investors are taxed on their proportionate share of the sub-fund's taxable income. This is despite the fact that the CCIV is a corporate legal entity that is able to pay a dividend. As well as transacting with each other, they can also invest in each other. But you can't do a circular investment. But many offshore collective investment entities and vehicles also work this way. Number 5, sub-fund dealing. Now, while sub-funds are not separate legal entities, they can get an ABN number and register for GST. That means they are thus deemed as separate tax entities. So they're permitted to transact and deal with each other as if transactions were being made by any other tax entities. While they cannot be part of a consolidated tax group, the capital gains benefits can be passed on. And number 6, foreign investor friendly. Now that, as mentioned before, for the Australian government, one of the main driving forces behind the CCIV legislation was the goal of having an Australian investment entity that was more attractive to foreign investors than the existing Australian structures. For example, I think around 4% or 5% of our total foreign investment was from overseas, which when you compare with Singapore at 80%, it was just too little. Up until the establishment of the CCIV regime, Australian investment entities were predominantly based on trust-based regimes, and most jurisdictions worldwide do not operate or widely use trust regimes, so foreign investors were cautious as they were not used to investing this way. For this reason, they often decided not to invest through that trust-based regime. So as a result, investors from most jurisdictions faced major challenges investing in Australia because they did not understand Australian vehicles, which they will do now because they're familiar and they're like other ones overseas. Like I know with Singapore, it's only had a year and a half. It's had its VCC trust, which is similar structure to the CCIV, and it has grown up to, I think there's nearly 400 of them now, and it's gone very, very well. So look, if you want to get more information, visit raisworth.com or look at the videos, search YouTube for Paul Niederer, and thank you very much for attending this and learning.